And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, joined today by Jay Jacobs of Global X Funds, Tim Seymour of Seymour Asset Management, Will Rhind, CEO of GraniteShares. Let's kick it off by taking a look at the third quarter. Third quarter saw heavy inflows into defensive sectors, and particularly gold and long-term treasuries getting a boost. Utilities and consumer staples continuing to outperform after stumbling briefly in September. Meanwhile, trade-sensitive cyclical names like metals, energy, materials, retail, they all lagged, along with healthcare. That got dragged down by biotech. So what's next as we gear up for the fourth quarter? Will, you run the GraniteShares Gold ETF, the symbol BAR here. Gold's outperformance really sticks out for this quarter. Is that going to continue into the fourth quarter?
I think it is. We've seen this trend from the beginning of the year in the U.S. of interest rates coming down. Interest rates are coming down across the world. That's not a great thing for anybody in the fixed income market, but for those looking for more defensive positioning, gold is something that's really benefited from that. The China trade talks, more broader uncertainty, just helping along that story.
And Jay, how does the Federal Reserve fix? And sometimes people feel there's a relationship between interest rates or the direction of interest rates that the Fed's guiding us in gold stocks. Do you see any relationship? Does that matter?
Yeah, absolutely. The more that the Fed cuts rates, the more attractive gold as a zero-yielding asset class becomes. And it's not just gold, it's silver, it's other precious metals where people like the defensive properties, but if interest rates aren't paying anything, it doesn't hurt that much to hold gold or silver.
So what are you telling your people now on gold?
Well, it's interesting also, what these guys aren't talking about is a technical argument for gold too. I mean, gold took 3-4 years to consolidate through a level that had been major resistance, and you can make an argument. You look at the rest of the precious metal space, and it's alive and well. So I mean, palladium's at all-time highs. People are playing gold-silver ratios. The one caveat to this, though, I think, is if you have this sense that we may have had that blow off top, and I'm not necessarily making that call in August in terms of rates where we got to those lows, I think that's going to be a headwind for gold in the short term. The same factors that I think these guys are talking about are probably medium to longer term dynamics that I don't think are going to change.
I guess the biggest problem I have with gold, Will, is it's sort of whatever anybody thinks it is. So years ago, it was a hedge against inflation. Now there's no inflation, so now it's a defensive play against chaos in the world. You could sort of make it whatever you want to make it, right?
I suppose at some level,
as an alternative investment.
Yeah, I mean, as an alternative currency, I think that's kind of the main role for gold in the modern portfolio. And thinking about gold and its correlations, the strongest one over time has been its negative correlation with the dollar. And obviously what we're seeing is a world where central banks are out easing again in Europe and elsewhere around the world. The US is cutting rates. All of that from a real interest rate perspective has a real correlation with gold. So real interest rates fall and gold prices typically tend to rise. And as Jay was saying, and Tim, when you have $18 trillion worth of government bonds around the world yielding less than zero or yielding less than gold, the opportunity cost of holding gold only increases.
Yeah. Speaking of negative yielding assets, the TLT, which is the 20-plus Treasury, long-term Treasuries, the biggest outperformer of all this quarter. Who would have guessed that one? 7.5%, not even including the yields on that. How long? We keep talking about a top in Treasury yields. It should have happened.
Maybe 4 decades going in this conversation.
Yeah, it hasn't happened yet. Your thoughts?
My view is that if you look at the PMIs and the leading indicators and all the macro around the world, it tells you that rates probably need to go lower. The question is, how far ahead of the market did yield curves around the world get as a function, really, of the ECB? And negative 50 bips on the Bund, I think I would make an argument that pulled our rates down. And I know people have a tough time believing that the Fed is the tail and the ECB is the dog, but I think rates got ahead of themselves. The U.S. economy is going to print 1.5% to 2%. This is not a negative yielding environment.
Yeah, there shouldn't be, right? I mean, we shouldn't have a negative yielding environment, right? Well, and it doesn't make sense to me. I have a hard time explaining it to my mother, who says, Robert, I heard you say that Germany had negative yields. How is that possible? You're giving money to the government for 10 years and you're losing money. And it's hard to explain.
Does she call you Robert?
It doesn't, Robert. It doesn't really make sense. You can't explain it to your mom very well.
It makes no sense. And look at the impact. What no one's really talking about is how negative this is for the banking system. I mean, look what negative interest rates have done to Europe and the banking system in Europe. We've got serious issues with Deutsche Bank that everybody knows, with Commerzbank, so reared its head last week. So, what we're not really talking about is the real negative impact this creates on the banking system, and I think society more broader in terms of everybody looking to save.
I completely agree with you. When I can't explain it to my mother, I get really worried because, she asked the right question. Robert, explain it to me, and I had a hard time with it. I want to shift gears a little bit and talk about what other issues will dominate in the fourth quarter. Now, some think investors need to find long-term growth opportunities that work even when the economy stalls out a little bit. And where might those investments be? Now, Jay, I've talked to you about this. You have some strong thoughts on this. Caveat here. Jay runs several big ETFs in the technology space. You run the robotics ETF. You run a nice cloud computing ETFs. We've had you on to talk about that before. They've sort of been sidelined this quarter as macroeconomics, global issues kind of come to the fore. But can they make a difference at all in the fourth quarter if things calm down?
I think they can. I mean, first of all, we're seeing strong returns in some very kind of traditionally boring asset classes like, TLT and gold, right? So once that starts to fade off, people are going to be looking for where are future returns going to be coming from. Just last week, the OECD cut their global growth expectations from 3.2% to 2.9%. That 3% level is kind of a very important mental barrier, but that means there's not a lot of growth out there. So which parts of the economy can continue to grow? We think it's disruptive technologies that are going to take market share from existing processes. That could be robotics that are now fully automating systems within manufacturing. That could be cloud computing, which is introducing tons of new innovative software into the enterprise space. But there's a lot of growth out there if you look more focused in technology.
And Tim, does this thematic investing concept still make a lot of sense, or are we still going to be buffeted around by global macro events, and this is not going to be that important? It's more like intellectual discussions about how the world's going to change rather than actual investment issues for the fourth quarter.
Right. Well, I'm an emerging markets investor by background, so I've always taken the view that you can invest in a bad neighborhood. Having said that, so in other words, if you're seeing global cyclicality headwinds, you're going to see it across a number of different ways to play that and express it. But if you look at, think of all the headwinds we had in the third quarter that we're now discussing the highs and lows of. I mean, and semiconductors effectively outperformed the rest of they outperformed triple Qs, they outperformed the S&P, and that's an environment where you would make an argument this is one of the most cyclical parts of investing. These are some of the most innovative companies in the world that are exposed to more advanced technologies, and they're not just, the DRAM chips and some of the commoditized parts of that belt. So I think you have to.
It's almost growth at any cost at this point. When the world loves growth, semiconductors are the first and foremost play on global growth, and the world hasn't given up on growth yet. That's what it tells me, the outperformance of the semiconductors, at least.
No, and you see that in the China trade talks, obviously, where people are desperate for growth. I think the biggest, forward-facing risk for all investors is technological disruption. And you see that in the trade talks and people's yearning for something to get done, so that we can get back to a situation where markets are growing or economies are growing again.
Yeah. Again, you want to watch that SMH, which is the broadest diversified ETF on semiconductors that are out there. Finally, I want to talk a little bit about what happened last week, because last week the Securities and Exchange Commission adopted a new rule designed to modernize the regulation of ETFs. I know it's a little wonky, but bear with me. These new rules, the SEC says, are going to facilitate competition, make things more innovative, give investors more choice, and allow ETFs to come to market more quickly. Is this going to help or hurt ETF investors? I know this is a little wonky. It's going to be up to you guys to sort of explain what did the SEC do last week and how does it help ETF investors or hurt them?
So first of all, I think it's a win for the ETF industry and for ETF investors. Probably the major thing that comes out of this is what's called a harmonization of the exemptive relief rules. And this is where
I've been waiting for years for harmonization of the exemptive relief rule. Just to say that just kind of turns me on. Continue.
Yeah, and this is where an asset manager had to go to the SEC and get an exemption from the 40 Act to allow them to list their shares on a stock exchange.
Now that made the whole process much slower. That's the key point.
It did. That's the key point, and it was not, different firms got different exemptions depending on when they asked over the years. So it was all a bit of a mess. And the upshot is the SEC has harmonized this so that now everybody, exemptive relief has gone away. And
so this is not just eliminating rules and regulations so that you don't have to do anything and the investors not protected anymore. This is just harmonizing rules. Am I right? I mean,
and better characterizing different products, right? I mean, mutual funds versus ETFs, they're different things. They shouldn't be treated the same way.
Yeah. So what does it mean for the average ETF? Are we going to see any difference? We'll see more product come to market. What does this mean?
I think we could see more products from more issuers. It lowers the bar for a new issuer to to come into the space and launch an ETF. So to be fair, over the last 10 years, that bar has been getting lower and lower and lower as more people have become ETF issuers and gone through the process. But there was still a bar there. Now that bar has effectively been taken away, so it's much more streamlined for someone to become an ETF issuer.
Now, here's a guy who's just gone through the whole ETF process with your cannabis ETF. Was it onerous and difficult? Do you think we could streamline the process better?
We could. To be clear, the exemptive relief issue, I don't think made my job any more difficult. I had a legislative issue where I had to get outside legal opinions on the underlying asset class. But I think what we're talking about as three guys that are in the ETF space, you have a dynamic where it's become more transparent, it's become lower cost. Competition in the ETF space is not lacking. I would say it's ridiculously competitive. And I don't think investors are lacking for seeing innovative new products come to market. I think these guys have them. So that's the dynamic that I think is ultimately what's in investors' best interest. But the cannabis ETF world is dealing with legislative dynamics and suddenly a lot of competition, and that's not a bad thing for people investing thematically and actively.
Yeah, you're right. There's no lack of competition. What, 1,600 ETFs? 2,000 almost, right?
Again,
we got 150 ETF families, funds that are out there.
Yeah. And to put some numbers on it for everybody, like this exemptive relief, 10 years ago when I first came to New York, that used to cost $1 million roughly to get that exemptive relief. Now you don't need it at all. So think about how much that costs.
Well, do we need a lot more innovation? It seems like you guys are doing all right. There's no lack of thematic ETFs. There's no lack of factor ETFs. There's certainly no lack of indexed ETFs. We covered the universe on that. Is this suddenly going to? Is this stuff you guys haven't thought about that all of a sudden is going to make it easier and come on the market?
I do think that hedge funds and institutional investors and retail and high net worth investors who are all in the ETF space to be able to trade a basket of securities and be thematic and be efficient. As a former hedge fund manager running a long short hedge fund, that didn't exist 10 years ago in the same way it does today. That's good for everybody.
Yeah, more efficiencies with still protections intact. I vote yes on any of that. Thank you, gentlemen. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Will and Jay and Tim for joining us today. And thank you for watching. Now, you can find, as always, all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Everybody have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.